this. There's 11 slides in this, so we should be alright to do it. But just as a recap from where we left off, we were talking about the mechanics of market profile. We discussed how it builds itself, how it has its time axis along the bottom, its price axis along the vertical, and that it starts building the information in terms of letters, each letter corresponding to a time period, i.e. half an hour, and those letters are called TPOs, time, price, opportunities. So when you hear me say TPO, it's time, price, opportunity, because it's representing, that one letter is representing the time at which it went there, the price, and the opportunity in that it traded. So volume went through there. Each half hour is designated by a letter. If the price is traded during that time period, the corresponding letter is placed next to the price. The exception is the O, which is, or the blue O, which is sometimes the open, or in my case I've got a red K. Whatever it is, it's important, so make sure you know what it's highlighted. As we have explained, because of the egocentrics that are the Americans, the beginning of their charts always begin with a capital A. So of course we correspond the beginning of our time frame with a lowercase k. If you really wanted to change it, of course you could. However, having been doing this for 15 years, it's ingrained in my mental state that I have to see it as a K. At the end of the first hour, when you have got the Ks and the Ls, we have what is called our initial balance. The initial balance is signified by the blue vertical line that is next to the profile. That initial balance, of course, being highly important, not just for the day that we're trading, but as I showed you on the stream 10 minutes ago, it was the low of the day today. So the low of the day, although we might not have wanted it to be the low of the day, unfortunately it was met with support there because it was an old initial balance high. So just as a reminder of that, in the Bund, this is our old initial balance high, signified here, and of course running forward through to today, that is where we have got our low of the day coming. So old initial balances are important, as are old opens, as are old closes. As the day progresses, the market auctions at prices. Buyers and sellers interact with their own view of value. This is what markets do. The letters run consecutively through the alphabet, switching to capitals after the Z print. It gives you and builds that picture that we have in front of us now as to where the market has travelled and how much time the market has spent in those areas. The range of the day is obviously signified by the highs here and by the lows here. Most of the time, the highest TPO count is the one that juts out. So the highest amount of TPO, time price opportunity, I've highlighted mine as pink so that I can see it a little bit clearer, so that it stands out to me. That signifies the highest price, or the price point at which the market spent the most amount of time. Nothing else, just time.
Large amounts of US data at half past the hour.
So, going back to our slides.
On US GDP, the headline GDP annualized is expected at 1.3%, which will be just above the prior 1.1%.
This is what we generally see.
Later at 2.3%.
And we'll show it to you on a live chart as well.
0.8%, all of which will be
So this is how we see the market profiles have built over time and over the course of a few days. In this case we've got 4 days here, and each area is signified by a certain colour and in a certain way. So here's where it gets interesting. In this case, the highest time price opportunity is highlighted red. In my case, I have it as pink, and you can see where it stands out there. Now, the green area that you were asking about earlier, this signifies 70% of the time that the market has spent has been in this area. So it signifies the highlighted area, the green highlighted area, represents where the market has spent 70% of its time. Now when we go back, and if you can flick in through your mind and remember where we had the scientific statistical deviation, we know that this is important, we know this is interesting, because scientifically this is where the majority of things, people, data, analysis resides, within 70% of that bell curve. Things, exceptions, outliers, and time is at the edges of our bell curve. So where we're organising things statistically, and we're organising things properly, and we're representing things in a scientific way and a proper data way, market profile organises it in such a way that candlestick charts that can't even get close to. A candlestick chart will never ever tell you where the market has spent 70% of its time. The market profile, so long as you have market profile, no matter what charting system you use, it will always be the same. And it will always tell you where the market has spent 70% of its time. This is called the value area. This is the area at which the market has said we are at value. This is where buyers and sellers agree that value sits. Markets find value. This is all they're looking to do. It gets to a point where buyers perceive the value to be too low and will step in and buy. It will get to a point where sellers think that the price is too high and they will step in and sell. And both parties will keep going back and forth and auctioning the market whilst they are trying to find value. Value does shift because things change. But whilst the market is relatively inactive, such as a day like today, you have a statistical market and a statistical bell curve. I'm going to show you the euro because it's a fantastic looking chart. This is about as scientific as it can get. We have spent 70% of our time in this range here, and buyers are saying that anything below this value area should be bought, and sellers are saying that anything above this value area should be sold. So on a pure balance day, a trader's job would be to buy below value and sell above value. And this is as perfect as it gets, in terms of a chart, because not only have we got 70% of the time that the market has spent in this area, But look what it corresponds to. The market had already decided this on our initial balance.
20 seconds, we're looking first at the US.
The market had already dictated this in the first hour of trade, that was where value sat, and it has not changed all day. The market has accepted value within an area. It's never going to be a precise tick.
The consumption 4.3 versus 4.4.
And the market has spent 70% of its time within this area here. These are the extremes of the market.
Initial claims 254,000 below the 260 expected.
Okay, 15% roughly either side. At the very extremes, of course, as per bell curve theory, it's going to be incredibly a low percentage of time spent there. Maybe it just flipped up then, or sellers stepped in. Yep.
When you said that it's
the
blue line again?
The initial balance.
Initial balance. That was set in the first hour of trading.
Yeah.
Which would be the K&L.
Well, this is the euro, so it's set slightly different because
okay.
it's a 24-hour market. In the bunds, it would be the K&L.
Okay.
I mean, the bunds has been relatively balanced as well, but obviously it's not been perfect.
Yeah.
So in this case, our value area runs from a high of 80 to a low of 65. That is your time price value area. Now, going back to our slideshow and our PowerPoint, the other things to keep note of with profile is this thing along the side here. This was innovated very recently. I say very recently. It's an evolution in terms of what used to be standard profile. You used to just have the letters, you used to just have the time price opportunity. About 10 years ago, people started adding volume to it. So along here, and this was pioneered by myself and a couple of other people in this country. It was big in America, but hadn't actually reached over here. Now everybody knows about it. This is your volume profile. So this doesn't account for time. So when we look at the bund, you can see how sometimes it is slightly different and slightly off kilter. So here we have a time price opportunity low of 90 and we have a high of 10. That's where the market spent 70% of its time. Yet the volume was spread out differently. And the volume value area low was 93 and the volume value area high was 11. And that represents where the market traded 70% of its volume. It does not care for time at all. Time on this area here is only significant in that it represents the whole day. Volume profiles and volume value areas are far more important than time. The reasons for this are: one, over the lunchtime period, we could spend an awful lot of time at a price, but there's no trading going through. What we're really interested in is where market participants are doing business. We care much more about where trading is happening as opposed to circumstance that just happens to leave it there for a long amount of time. The other thing to bear in mind is that computers and algorithms have no concept of time. Only what's programmed in. They have no concept that they might be getting bored, or that we might be getting bored, or that, you know, we're just waiting for figures to come out. And what has happened certainly nowadays is that the markets take a lot longer for things to go through and for the markets to react, because the algorithms are spending more time trying to hide their positions, mask their positions, and rattle locals out. So what we really care for and what we really care about is where actual business and actual trading was done. And that's why this edition here is one of the most important additions that we've seen, you know, to technical analysis and market profiling in the last, 10 years. So this box along here signifies all of the volume done on the day, and as per bell curve theory, this area here, your orange area here, signifies 70% of the volume traded on the day. The red line to the side of it is the price at which the highest amount of volume has gone through. That is called your volume point of control, your VPOC. In other words, it's at this price that buyers and sellers agree on value. It's at this price that the market says, do you know what? Yes, we're fluid. Yes, we tinker up and down. Yes, we ponce around. But this price point is accepted value. Throughout the day, that can shift. Value can shift. As the day progresses, the purpose of the market is to facilitate trade. The purpose of the market is to try and find the best possible price to do this, where buyers and sellers agree that the price is fair. Fair value. It's at that price that the auction has balanced and that everybody agrees. And of course it shifts, and if sellers disappear for a bit, buyers might try and push it up until such point as sellers step back in and say, calm down, this is out of value. So in terms of your profile and the things that you are noticing and looking for, your TPOs are your time price opportunities. Your green TPOs are your 70% value area. Your orange areas are your volume value areas. And as your full market profile progresses, as we have seen, we go on all the way through the capital letters, and we end up with a full day's information. We end up with our high, our low, our initial balance high, IBH, our initial balance low, IBL, our TPO value area highs, our TPO value area lows, our volume value area highs and our volume value area lows. We also find our opens and our closes, as well as our TPO points of control and our volume points of control. We end up with all of those bits of information from one profile. So when we go back to the beginning, we already know tick, we know that, we know that, we know that, we know that. Okay, so moving on.
They'll exceed their
The midpoint. At the end of the day, your chart should signify the middle of the day, the midpoint, the 50%. It's the 50% from the full high to the full low. So again, on my chart, when I look across here, my 50% is signified by that pink K in the middle. I don't care how it signifies it. I'm not, it's not, however it posts it on your chart, I don't mind. But you should always know what the middle of the day was, your midpoint. Now, these things, as we move forward, we will be coming back over them again and again and again. But one thing to remember, and one thing to keep an eye on, is what we call buying tails and selling tails. A buying tail signifies a point where a buyer steps in and responds aggressively to the price and buys aggressively at market. A selling tail is obviously the opposite. It's a point at which the seller steps in and aggressively sells the market because they feel that prices have got too out of line. In perfect auction theory, a market profile should always have a buying tail and a selling tail, because it's at that point that the market has got out of line and a seller has stepped in and sold the market aggressively, and if it's gone too low, a buyer steps in and aggressively buys the market. You should, in perfect theory, always see a buying and a selling tail on your profile. Now, if we look at the last few days in the Bund, we have had a good selling tail here. Prices up here got too far. Sellers stepped in. It should always have, a selling tail should always at least have, 3 or 4 prints to it. So an aggressive seller stepped in, signifying that the top of the market had been reached, signifying that this market had gone too far. Again, yesterday, a seller stepped in a bit more aggressively, lower, stepped in and sold it at a lower price more aggressively. So again, this should signify that there's pressure in the market, that sellers are stepping in, and if they're stepping in at lower prices, then the trend is changing. However, more and more often than not, we find that the markets don't actually always leave perfect buying and selling tails. And this is where you will hear me talk, and you would have heard me talk today, about a bad low or a bad high. This is a bad low. It means that the market has not actually found an aggressive buyer yet. It means that the market has done unfinished business there. It's done too much volume there, and that they haven't actually found the aggressive buyer who is willing to step in at those prices and aggressively buy the market. It should signify that the market is going to go lower. However, time becoming less of a factor, this would in older days have happened on the same day. You would not have, you would not have seen this happen. But nowadays, as things take a bit, the market holds itself in position a bit longer, and shorter term traders don't hold overnight positions, you do find that these creep in more often. We saw one yesterday. It was a bad low. The market came down to a price point an important price point, of course, because we had this high at 75 across here, and we had this, which we'll look at, single prints. It's an area where the market gaps away a little bit and shifts, but it left a bad low there. So when we all walked in this morning, not only had we seen two reasonably good aggressive selling tails, but we'd seen a lot of bad lows. And we were looking and expecting the market to challenge these bad lows, because they shouldn't be there. It's unfinished business. We haven't found our buyer yet. We found our aggressive sellers. The sellers are starting to take control. They have done again today. We've got a good selling tail today. And yet the market can't quite break through. The sellers are nervous. The sellers run out of aggression down here. But we haven't found aggressive buyers. The sellers have just stopped selling. The buyers aren't buying. But it does signify a change of heart in the market. It signifies that this market is attempting to push lower. We just need to find some aggressive sellers. Now, my theory on this is that we're coming to month end, which again tomorrow we'll talk about, but you tend to find that there are at this time of the month more buyers than sellers in the bond market. I'll explain why tomorrow. So I think that as prices auction lower, the sellers are getting a little bit too nervous. They don't want to get caught out, so they just stop selling. But we haven't found aggressive buyers. So the potential should be that we are still bias short, or want to be bias sellers, because we think that if we can just get an excuse for the sellers to come in, there shouldn't be buyers here. So we're always looking, when we're looking at our structure, we're always looking for selling tails and buying tails to give us an indication as to who's taking control of the market. Who's got more armory? Who's got more guns? In terms of this little example here, again, this is what's called an open drive. This is where the market opens up and aggressive buyers step in. It's slightly different to a buying tail in that the open is at the low. When we have an open drive, pure auction theory dictates that the buyers will remain in control for the rest of the day. However, recent statistics have proven that this only happens 20% of the time, where we open drive higher and buyers stay in control for the whole day. But our pure auction theory is that on a pure open drive, they should. Now, a great example of this, and you know what, we're probably going to have to come back to this slide because I'm not sure we're going to finish it, but that's fine. I don't care, because this is so important. I don't care if we spend 3 weeks on this to get this sorted. A pure open drive very, very recently was here. Very recently in the Bund, we've opened at the K print, low of the day, open drive higher, and buyers stay. You can see we auctioned significantly higher over the course of the day. We actually rallied at our strongest point. We were up nearly 100 ticks a point. That is called an open drive. That only happens 20% of the time. But pure auction theory, and there was a big argument about this on Twitter, big argument, because the pure auction theory is that once you assess this and you see this, you should be biased long for the whole day. However, a lot of smart asses on there said, yeah, but this only works 20% of the time, so I'm looking to sell the market because we should break this low. So of course they had a particularly bad day, because for the first time in quite a long time, you know, pure auction theory did actually work. Now, an example of where it didn't work would have been, well, actually saying that, this day it worked as well. We had an open drive, buyers remained in control for the whole day. However, where was it? There was a day where where was it? This day here, you can see the K print would have been the high at the point. So the K print sold us down, sold us right the way down here, an open drive lower, but of course it didn't work because later on the P prints and later on in that day, that actually got broken through. And so this happened, this setup happened quite a lot running into this day, where we had an open drive and that open was not and should not have been the high or low for the rest of the day. However, the two subsequent times after that, we did have an open drive and the buyers did remain in control for the full day. Again, just another example that I have already shown you. This is an example of a weak high. This is a weak high. This here is a weak high, or a bad high. It's bad because no aggressive selling has come in. Just buyers have lost interest. It means that the sellers aren't actually willing to step in here. It's just the buyers aren't willing to take it further. So it's not found its top yet. You should always be thinking, if you've got weak highs, weak lows, that we haven't found our high, we haven't found our low. We should break through this. However, as the rest of us here know, sometimes it takes half a dozen attempts before we do break through it. But you should always be thinking in terms of the market breaking through it. Of course, all of this should and needs to be done not just on a daily basis, but you merge the profiles so that you get weekly profiles. So you get your, and I say weekly as in time period. I remember I used to talk about weekly profiles, and a German guy did think I meant W-E-A-K, not W-E-E-K. So weekly as in terms of time period. The weekly market profiles again would signify where the market has travelled during that week. It will show you where it spent 70% of its time. It will show you where it's done 70% of its volume, and it will show you where last week's accepted value was. And it again, you start looking for time periods and you start looking for shifting value. Is the market value shifting up? Is the market value shifting lower? What is happening here? Is the market saying that value is getting higher and higher and higher? Or is the market actually saying value is staying the same? Or is it shifting lower and lower and lower? And it gives you your bias. This is where you start to get your bias for where the market is likely to travel. Not where it's definitely travelling, but where it is likely to travel. So patterns of behaviour. Markets seek balance and acceptance of value. There are three measures of balance. We've discussed two of them, the volume point of control and the TPO balance point, the TPO value area. The VWAP we will come back to. And if all of these are in alignment, these three things, then you have pure balance. And I would also add Bollinger Bands to that. Bollinger Bands are a measure of balance. When a market is out of balance, it auctions away from the previous point of control to find new accepted value. So to sum up, there are just a couple of other things after this I want to go through. What are your key market metrics? What are they? Your highs, your lows, your TPO value areas, your volume value areas. Where is fair value? Where is the market saying that value is established? Who is in control? At the moment, the sellers are marginally controlling the Bund because we've seen 3 days of selling tails, but 3 bad lows. So the sellers are just ever so slightly in control. Not aggressively, just ever so slightly. What are the extremes? How did they trade? Were they bad highs? Were they bad lows? Were they good tails? And where might the profile look to extend to? Again, you can predict a lot of what you see me do is you've seen me when I go through the streams, you see me look for where I feel the market needs to auction. All price needs to be auctioned. All price needs its moment in time. Every price should be traded. Okay, that's why gaps in the market, and when the market moves away with big gaps, you tend to find they get filled. Now, just very, very quickly, because I've got to do the 2 o'clock stream. 2 things to point out. These little pink lines here, they are called single prints. They are where the market has accelerated away from an area in one time frame and it's not come back to trade through at that price. So the market on this day here has only traded this price of 66 at one time frame. It has accelerated away. It's left at that price point, it's left a decision point and a reference point, and the market's accelerated away from it. Up here, 75s, 74s, that's where the market accelerated. That's where buyers stepped in at highs and said, we're shifting this. We're now shifting value. We're accelerating away from here. It's important because the market came back to it, and it's where the buyers stepped in, or it's where the sellers in this case got too nervous to sell anymore, because it was the last point where this market aggressively moved away, and it aggressively said, we're shifting value. Value yesterday was down here all the way at 36. Well, we shifted that over the course of the afternoon, and of course at this point this morning no one was interested in selling here, and so we crept up here and a decision was made. The buyers said, okay, maybe we didn't get where we wanted to buy down here, we never got to be aggressive at that price point, so we're now going to have to be aggressive at the higher time frame, and the market accelerates. Where you have gaps in value area, as we have done here, you should always be looking for the market to come back and trade that value area. All markets and all prices need their time in the sun. They should all get auctioned. Every price should have its moment of auction. And if it hasn't, you need to remember it as a reference point. Okay, well look, I'm going to leave it there for me. We are going to come back over this. You are going to read a book on this. This is just scratching the surface of the most important principle that we want to go through. When I finish my 2 o'clock stream, I'm going to put a video on for you to watch. So get yourself set up in here to watch it on the live on the VTFT terminal. I'll do my stream now. I'll come back in and make sure that everything's running just after, but then I will leave you with a video. So I will speak to everyone in a couple of minutes on the live terminal, and then I will set you off for the afternoon with a video.